Welcome to this tutorial on Chapter 18 and the calculation of a partner's partnership interest and what would happen if a partner was to withdraw from a partnership. We're going to start off by talking about partnership interest. Now, a partnership interest basically is the right to share in the profits and losses and the right to partnership property. Now, when a partner joins a partnership, they're going to contribute assets to the partnership, and maybe cash or maybe other assets. So to start off with, the partner's partnership interest adjusted cost base will initially be equal to the fair market value of the assets contributed. So if a partner joins a partnership and they contribute $100,000 of cash to join the partnership, that would be their initial adjusted cost base of their partnership interest. Now, a partnership interest is considered a non-depreciable capital property. So when if the partner eventually leaves the partnership, they will be disposing of that partnership interest, and there could be a resulting capital gain or capital loss. So that will happen if a partner was to withdraw from a partnership. Now, if the partner is admitted by buying the partnership interest from an exiting partner, so a new partner wants to join this partnership and an existing partner wants to leave, then the new partner can just buy the partnership interest from the exiting partner. In that situation, the adjusted cost base of the new partner's partnership interest will just be equal to what they pay. And for the exiting partner, they're going to have been disposed of their partnership interest, so their proceeds for disposition will just be the price that they paid. So fairly straightforward. Now, if a partner wants to join a partnership, but there's no exiting partner, all they're going to do is buy some of the existing partnership interest. Then the existing partners will be deemed to have disposed of some of their partnership interest to the new partner. So that means that the existing partners will be disposing of some of their partnership interests. So the existing partners may have a capital gain or loss in that situation. Now, moving on to the next slide, what are some common adjustments to the adjusted cost base of a partner's partnership interest? Well, initially, it's going to be the fair market value of the assets that the partner contributes. So if, once again, a partner joins a partnership and they contribute some assets, the fair market value of those assets will be added to their adjusted cost base. Now, if the partner later on makes additional capital contributions, those will be added to the adjusted cost base. However, if the partner takes drawings from the partnership, that will be a deduction to their adjusted cost base. Now, these adjustments are made at the time the contribution is made or the drawing is deducted. So any capital contributions or drawings made by the partner, those amounts will be adjusted right away to the adjusted cost base of the partnership interest. And that's important because there are some other adjustments that are made not at that time. So for example, these are adjustments that are made on the first day of the following fiscal period. So let's talk about the first one. So the share of the partner's business income or loss. So let's say, for example, in 2018, the partnership had business income. Now, the partner's share of that would not be added to their adjusted cost-based partnership interest until the first day of the following year. So if their share of the partnership's business income was $10,000 for 2018, that amount would not be added until January 1st, 2019 to that partner's adjusted cost-based partnership interest. Also, any dividend income, capital gains, capital losses, the partner's share of those amounts would not be added or would not be adjusted to their adjusted cost base until the first day of the following fiscal period. And we're going to look at an example to bring this into light in a few minutes. Also, if the partner is going to be allocated some amount of charitable donations or political contributions, those would be considered deductions to the partner's adjusted cost base of their partnership interest. And once again, this adjustment would not be done until the first day of the following fiscal period. Now, there could be a situation where a partner's partnership interest might be negative. They might have a negative ACB. So remember, they get allocated their share of the business income or loss. So if there's a lot of losses that the partnership is experiencing, that particular partner might have a negative ACB. So how do we deal with negative ACB? Well, if the partner is a general partner and they're active in the partnership, they don't have to worry about it. It just remains negative. They don't have to take any amount into income. However, if they're an inactive general partner or they're a limited partner, if they do have a negative ACB in their partnership interest, they have to take that negative amount into income as a capital gain. 50% would be taxable, and that's going to reset the ACB to 0. So that's what happens if you are an inactive general partner or a limited partner and you have negative ACB. Moving on to the next slide, we're now going to look at an assignment problem in your textbook. So look at assignment problem 18-7. Now read through the problem first and just look at part A. Specifically, what I want you to do is to make the allocations to each partner from January the 1st, 2016 to December 31st, 2018. And what we want to figure out then is what's going to be the adjusted cost base of each partner's partnership interest at January 1st, 2019. So we're looking at the first day of the new fiscal year, January 1st, 2019. So we're able to include all the allocations of business income, capital gains, dividends, if those are relevant, up until the end of 2018. So let me just get you started here. We're going to set up a column for each partner, Tammy, Loretta, and Crystal. We're going to start off with their initial capital contributions. So we're trying to figure out what is the ACB, adjusted cost base, of each partner's partnership interest at January 1st, 2019. So we're going to make all the adjustments from the start of the partnership, January 1st, 2016, to the end of December 31st, 2018. So make all those adjustments, and then once you've calculated the adjusted cost base as of January 1st, 2019, then resume the video to check your answer. So pause the video now. Okay, let's take a look at these adjustments to the adjusted cost base. So we started off with the initial contribution by each partner, and then each partner made additional contributions of $104,000. So those get added to the adjusted cost base. Also, drawings, they're deducted from the adjusted cost base. So those are the amounts for each partner. And then we allocate the net business income. And so each partner will get 1/3 of the net business income. So that as an addition to the adjusted cost base. Then we have capital gains. Now, based on the partnership agreement, only Loretta and Crystal get the capital gains. So that would be the amount allocated to Loretta and also Crystal. And then the dividends, they only go to Tammy. So the dividends go to Tammy, $6,300. Now, we're only using the actual amounts. Now, the capital gains and the dividends, when the capital gains are reported by Loretta and Crystal, then they themselves will take 50% of that in their calculations. The dividends to Tammy, we're only looking at the actual amount of the dividends. When Tammy actually reports the dividends on her income tax return, because they're eligible dividends, she will have to gross them up herself. But in terms of the adjustments for the adjusted cost base, we're looking at just the actual amounts. And then we have the donations. And once again, the donations reduce the adjusted cost base, and each partner is going to get 1/3 of the total donations. And so that's how we're going to arrive at the adjusted cost base for each partner at January the 1st, 2019. Now, moving on to the next slide, we're now going to look at part B and part C of the problem. Now, in this part of the question, we want to figure out first, what is Loretta's capital gain or loss when she withdraws from the partnership. So when she withdraws from the partnership, she will be disposing of her partnership interest. So we have to take the proceeds of disposition minus the adjusted cost base minus any selling cost, and that's going to be her capital gain or capital loss. 50% of that will be taxable or allowable. So figure that out first, and then figure out what's going to be the impact on Tammy's and Crystal's partnership interest. Now remember, in the question, each of the other partners will pay Loretta $210,000 cash for one half of Loretta's interest in the partnership. So Tammy and Crystal are each going to be paying $210,000 in order for Loretta to withdraw from the partnership. So figure out those amounts, pause the video now, and then once you're ready, then resume the video. Okay, let's look at Loretta's disposition of her partnership interest first. So Loretta is going to receive proceeds of $420,000, and from that we're going to subtract the adjusted cost base of her partnership interest, which was $416,100. We figured that out on the previous slide. But she also has selling cost, legal and accounting fees of $2,300. So that's going to increase the cost and to $418,400. So the capital gain is going to be $1,600. Now, one half of that is taxable. So her taxable capital gain for 2019 that she would have to include on her own tax return is $800. Now, part C, once again, in the question, they talk about the fact that there is some partnership income for January, but remember, she's not going to be eligible for that because that partnership income for January 2019, that won't be allocated to the partnership interest until January 1st, 2020. So she won't be given any of that income. Part C, now because Tammy and Crystal are paying $210,000 each, their adjusted cost base of their partnership interest will increase by that amount. So Tammy and Crystal's adjusted cost base of their partnership interest, each of their partnership interests will increase by $210,000 because that's the amount they're paying in order for Loretta to withdraw from the partnership. So that brings us to the end of this assignment problem and also to the end of this tutorial on partnership interest. Good luck with your studies.